and welcome you. Tune into Rush Hour with me, Ankita Saxena. Well, the hottest news perhaps is that the former US President and Republican candidate Donald Trump was shot at by 20-year assailant while he was addressing a campaign rally in Pennsylvania. Well, speaking to the media, he shared how it was supposed to be, how he was supposed to be dead, and adding that he was saved by either luck or by God. Trump sustained a ear wound and the assailant was shot dead. Meanwhile, US President Joe Biden addressed the nation on the horrific incident and asked Americans to lower the political temperature. PM Narendra Modi took to X, formerly known as Twitter, condemning the incident. Also, King Charles III also wrote privately to Trump and the message was delivered via the UK embassy in Washington. While Trump's bloodied image has taken the political arena by a storm, especially ahead of the fast approaching elections in the USA. Well, to weigh in on let's go across and listen in to what Joe Biden had to say about the incident, and then we'll be joined by guests to weigh in on the impact of that on the markets and otherwise. All right, we'll move on to the guests who are joining us. Geoff Dennis, independent emerging markets commentator, and Arnab Das of global macro strategist, EMEA, joining us to weigh in on the situation. Hi, gentlemen. Welcome to Rush Hour. Mr. Dennis, I'll come to you first. Well, the shocking weekend shooting has injected an unanticipated wave of uncertainty into the already turbulent election season, potentially casting a long shadow perhaps over the US economy for at least the next 3.5 months. Now, even though the shares of Trump media and technology groups were higher, 50% higher in the pre-market trading session, what does this mean for the US markets in the short term, at least for the next 3 to 4 months?
Is this for me?
Yes.
Okay. Good.
Yes, Mr. Dennis, this one's for you.
Yeah. I think, first of all, it's a terrible tragedy. It's an appalling situation that we still have political violence of this sort in the US. But investors and markets always want to see one angle or another from this. And I think at the end of the day, what this will do is to increase the chances that Donald Trump will win the election. It takes some of the focus off the viability of current President Joe Biden's candidacy for potential health reasons. There'll be a certain amount of sympathy, if one can use that term, with respect to ex-President Trump. And I think the market and investors at the margin would prefer a Trump victory to a Biden victory because of the promise of potentially lower taxes, etc. So I'm not surprised by the recovery in stocks, or I should say the further rally of US stocks this morning. And I think what's also very interesting is normally when you get political events like this, you would get a flight to quality with a major move higher in the dollar and in bond markets. That's not happening today. What you're getting is a rally in equities. And I think that's on the basis that investors at the margin, as I say, think this terrible event will increase the chances that ex-President Trump will win the election.
To you, Mr. Das, as Mr. Dennis rightly pointed out, that this might increase if the chances of Trump coming back to power, and that is a big positive for the markets. But if you look at, his potential return to the Oval Office presents a bit of a paradox for the equities. Now, on one hand, Trump's policies could continue to support the large fiscal deficits buoying the stock market. On the other hand, these deficits could exacerbate the already, higher challenges for the higher inflation and rising US yields. Now, also, if he comes back to power and he continues with higher tariffs for China, that could lead to a potential trade war also happening. So in the long term, if he has to come back to office, how will this impact the markets?
Look, so first, I think I sort of broadly agree with Geoff. That's what's going on. What's being priced in is at least initially somewhat higher chance that Trump will win. And I think that's consistent with what you're saying, right? It would be consistent with expectations that the tax cuts might be renewed. There might be more, of a larger fiscal deficit than otherwise. There might be higher tariffs. I think it's also possible that we would see greater immigration curbs and maybe some meaningful reversals of immigration that's already taken place. So these policies would be, probably growth friendly, but also, somewhat inflation oriented or reflation oriented overall, right? And that might imply that the Fed eases more slowly or indeed even less than otherwise, right? It seems like the US economy is cooling down now and inflation is cooling down. The jobs market is cooling down. So we're headed towards the first of possibly a few or more Fed rate cuts. And my sense is that probably won't make too much difference for 2024, but in 2025 and 2026, if Trump is reelected, of course, that's when he would be implementing policies subject to whatever kind of Congress we get. And I think that's kind of what's being priced in, a higher likelihood of those kinds of policies, and hence a somewhat steeper yield curve, a somewhat stronger US dollar, and a somewhat stronger America first kind of stock market. I think China, as you say, would be in the kind of sights of the Trump administration, but not just China. Europe as well, and a number of countries and regions that have surpluses with the U.S. So I'm not sure that we would see a huge increase in a trade war. At least not on day one. I think we'd see a lot of bargaining and a lot of pressure, and that would, initially imply a stronger dollar. Trump, people close to Trump, and some degree Trump himself, have sort of suggested that they would prefer a weaker dollar. I'm not sure how they would engineer that, but so a lot of challenges and a lot of interesting, let's say, macro and financial fallout if that were to come to pass. I think it's also worth saying that this takes the focus of the media and maybe to some extent the public away from the viability of the Biden campaign. But I think there's a decent chance that the struggle within the Democratic Party about what to do about the perception that Biden is not all there and is in a bit of cognitive decline, that struggle will probably continue, and we may see some results of that in the coming days or weeks. It's not a given at all, but it's something to still bear in mind.
Right. Mr. Dennis, what do you think about the fact that the U.S. markets, the U.S. economy is now cooling off, the labor markets are cooling off, the inflation has also cooled off a bit. How does that pave the way for interest rate cuts this season? I mean, the analysts are expecting a first rate cut in the month of September. Do weigh in on that.
Yes, I mean, I think we're on a complete obvious glide path now to rates being cut in September. My view for a long time was they'd be cut in July, and I think I would cut in July, but if I were in charge here, but the market has not been lined up for a July rate cut, but we're certainly in line for a September rate cut for all the reasons that Arnav has said, and I think that we'll get another one in December, frankly. And so I think it's almost a given now, unless we get some shockingly strong macro data or inflation data over the next few weeks, which seems pretty unlikely, frankly. Now, I agree with what he says also in terms of the long term. Now, what I meant by arguing that the market likes the idea that Trump could win the next election, and this tragic event could increase that possibility, and therefore more likely to get tax cuts. But and I was absolutely right that the longer term outlook here under both presidents is not good with respect to the fiscal deficit. Nobody seems to care in the US about fiscal deficits anymore. And certainly the Republican Party, which is the party of low taxes and small government, doesn't care about the budget deficit. And so at some point down the road, there will be a rise in bond yields, I think, again, on the back of the concern over the growing fiscal deficit. But as Arnav has said, I think that's an issue for 2025, 2026. And it's a very, very significant policy challenge. And it probably also means that the inflation downturn will have a limit to how far it goes. Inflation may turn up again at some stage because these are inflationary policies. And therefore, how much the Fed is able to cut rates beyond 2024 is definitely is clearly not obvious. And therefore, I think this bullish news for equities from what the Fed is going to do and at the margin from these terrible events in Pennsylvania is very much, I think, a short to medium term view, not necessarily a long term view.
Right. Okay, coming to you, Mr. Das, this week brings earnings report from companies like Bank of America, BlackRock, Netflix. Aside from the companies, the main point of interest will be the retail sales that's likely to come out on Tuesday night, and a speech from the Fed Chair Powell early on Wednesday morning. What are you expecting from those numbers and, of course, from the speech?
Well, we don't make point forecasts of all these numbers, and certainly don't prognosticate, precisely what's going to be said. But I think, the economy is slowing, as we're saying, so that should take some of the steam out of retail sales. And I think, it seems likely that Chair Powell will continue the kind of alignment of stars for September, as Jeff said, September and probably December as well, as is largely priced in, rather than July. I think they'll probably need to see a bit more data. They'll probably want to have kind of one of the quarterly processes of forecasts and the summary of economic projections. And so they'll point in that direction and guide the market to, or keep the guidance around the market where it roughly is, without doing too much forward guidance and without doing too much of a being too definitive about it, but still pointing us in the direction that the market is already latched onto. I think the earnings reports will continue to be fairly strong, right? Corporate America, I think, by and large, not all of it, but much of it is in very good shape. The economy, although it is slowing, and although the labor market is softening, it still remains in relatively good shape. And that's why I think we're talking about a series of gradual cuts that may have a limit here, rather than kind of the almost traditional thing that has happened in the past, right? When the Fed tightens, something has broken. It's usually the financial sector. Something in the financial system goes wrong. We've had a little bit of that, but it hasn't been systemic. It's been quite idiosyncratic, and it therefore hasn't been recessionary, hasn't caused the labor market to crack. So what we're seeing, I think, is a rebalancing of the labor market, where it's sort of normalizing, going back to kind of maybe the pre-pandemic sort of dispensation, right, where labor market was fairly tight, but not aggressively tight, as it had been in the aftermath of the reopening and the massive amount of fiscal support that was there. Which is what, as Jeff was saying, right, that there don't seem to be any fiscal hawks left in the U.S. I think there are under the surface. They're not taking flight because this is not the moment to do so. But I think we are in a situation where the economy is clearly responding to the rate hikes that have taken place, not by falling off a cliff, but by slowing appreciably. And I think that's what we'll continue to see in indicators, like you say, like retail sales, and in due course earnings reports as well.
All right, Mr. Dennis, Mr. Das, thank you so much for joining us and taking the time out. We will let you go on that note.